SpaceX stock dropped 31% in less than a week, and the people who bought it at the top are now doing math they didn't plan on doing. Today, I want to show you exactly what that math looks like, and why the number that gets you into a hype stock is almost never the number that gets you out. First, some quick context if you missed the IPO episode. SpaceX went public on June 12th. Here's the first thing nobody tells you. SpaceX priced its IPO at $135 a share, but that price went to giant institutions, not to regular people. When the stock actually opened so anyone could buy it, it was already at $150. Then it took off, climbing to an all-time high of $225.64 just 4 days later, on June 16th. If you'd bought at the open, that's a 50% gain in 4 days. No wonder everyone wanted in. Financial media called it the most anticipated IPO of the decade. Retail investors poured in. The excitement was enormous. Then it fell. By June 22nd, the stock had dropped to around $154. That's a 31% decline from the peak in 6 days. Now here's the math most people skip. If you invested $1,000 at the top at $225, you now have about $684, or you lost $316. To get back to $1,000, you don't need a 31% gain. You need about a 46% gain. That's the recovery math trap. Losing 31% and gaining 31% are not opposites. They don't cancel out. When you lose a third of your money, you need nearly half again just to break even. This is one of the most important concepts in investing, and almost nobody teaches it before you learn it the hard way. So, why did SpaceX's stock do this? Let's look at the fundamentals. Morningstar, one of the most respected independent research firms in the investing world, put their fair value estimate for SpaceX at $62 per share. The stock hit $225. That means at its peak, SpaceX was trading at more than 3.5 times what analysts believed the business was actually worth. This is called a valuation gap, and it happens when hype and momentum push a price far beyond what the underlying business justifies. Remember what we said in the stocks episode. A stock is not just a ticker and a chart. It's a small ownership stake in a real business. The price should, eventually, reflect what that business is worth. When it doesn't, the gap usually closes. Sometimes slowly, sometimes fast. In SpaceX's case, fast. Some big-name analysts started calling SpaceX a $2 trillion meme stock because of the intense retail excitement and rapid price swings. Other analysts pushed back. They said that's not fair because, unlike a meme coin with nothing behind it, SpaceX is a real company that launches real rockets and runs Starlink internet for millions of people. So what's the truth? Both. Kind of. SpaceX is absolutely a real business. But even a great business can have a price that runs way ahead of what it's actually worth. And that's exactly what Morningstar is warning about. A $62 fair value versus a stock that hit $225. The price had detached from the value, and that gap is what collapsed. Here's the lesson that applies to every hyped stock you'll ever see. There are two different things people buy when they buy a hot IPO. Some people are buying the business. They've looked at the revenue, the growth rate, the competitive position. They have a thesis for why the stock is worth more than the current price. They're comfortable holding for years. But most people buying a hot IPO are buying the momentum, the excitement, the headlines, the feeling of being in on something big. They're not buying a business. They're buying a story. And stories, and especially in the first week of an IPO, can reverse very fast. So how do you tell the difference before you invest? 3 questions. Question 1. Do I understand what this company actually does to make money? Not the mission, not the vision, not the founder's name. How does revenue get generated? Is it growing? Is it profitable? If you can't answer that in one boring sentence, you're buying a story, not a business. Question 2. What's the fair value estimate from an independent source? Not the IPO bank, not the hype articles, Morningstar, analyst consensus, discounted cash flow models. If the current price is 2 or 3 times the fair value estimate, that gap has to close somehow. Question 3. Am I comfortable holding this for 5 years? Hype stocks can take years to either grow into their valuation or fall back to earth. If you'd panic sell at a 30% drop, you're not investing. You're gambling on timing. None of this means SpaceX is a bad company. The rockets are real, Starlink is real, the business is real. But at 225, you weren't paying for the business. You were paying for the hype on top of the business. And hype is the one thing that doesn't show up on a balance sheet. Here's your challenge. The next time you see a stock making headlines for going up fast, find the independent fair value estimate. Morningstar has a free tier. So does simply reading analyst reports. Compare that number to the current price. That gap tells you more than any headline will, because the math of recovery is ruthless. A 50% loss needs a 100% gain to break even. A 75% loss needs a 300% gain. The hype gets you in. The math is what you live with after. If this changed how you think about IPOs and hot stocks, hit subscribe. And tell me in the comments, did you know that losing 31% and gaining 31% don't actually cancel out? See you in the next one.